as
what have
well.
we
But
learned in the last 9, 10 years? Expect the unexpected.
again, this is the type of volatility that bond investors are just not getting paid for at the moment. Dario has another great chart on looking at the spread of inflation expectations and forecasts of inflation as compared with term premium, and that for most of the history tracks pretty well, apart from in the 1980s when people were just conditioned to expect inflation to be really volatile and kind of the forecasts were broad because there was this continuation of in the 70s the forecasts were very broad, and as that started to kind of come in over the 1980s, investors continued to ask for more in term premium to compensate for them for kind of inflation volatility, even though inflation volatility was coming down. Now we're in the sort of the reverse of that, where there is this just continuous risk of shocks and kind of quite significant negative supply shocks, not a big enough negative supply shock to really sort of tip us into those different into that different kind of dynamics of inflation, where bond investors would immediately say, look, term premium just needs to be much higher. We've had sort of inklings of that in post-Liberation Day, when you started to see some of those correlations moving. But at this stage in the game, there's just this debate. Is there going to continue to be lots and lots of smaller negative supply shocks? And it's really hard for markets to price that in. And that's a sort of a euphemistic way of saying that at this moment in time, bond investors are not being compensated for the level of risk. And similarly, the flip side of that, literally the inverse of that, is that US valuations are simply too high.